Supermicro computer is currently trading around $31.99, reflecting a decline of approximately 4.8% on the day. The stock has experienced a 52-week range of 2760 to 6236 and maintains a market capitalization near $19 to $20 billion. In the most recent quarter, Q2 FY26, ending December 2025, SMCI reported revenue of $12.68 billion, representing a 123% increase year-on-year, while net income reached $456 million. However, net margin contracted to 3.16%, down from approximately 6.9% a year earlier. Valuation metrics indicate the stock trades at a mid-teens forward PEE and an EV sales ratio near 0.5x, materially below larger AI server peers that range from 0.8x to 1.1x EV sales. The key question facing investors is whether the market has accurately priced a structurally low-margin, concentrated AI hardware company, or if SMCI is at risk of being a value trap despite robust AI demand dynamics. Revenue growth remains a core strength. The $12.68 billion reported in Q2 FY26 exceeded expectations by roughly $2.4 billion, surpassing prior guidance of $10-11 billion and consensus estimates of $10.2-10.3 billion. This reflects both a 123% year-on-year increase and a sequential gain of approximately 153%, positioning SMCI as one of the fastest-growing names in AI infrastructure. Management projects Q3 FY26 revenue above $12.3 billion, significantly above prior street estimates near $10.17 billion, while full-year revenue is guided in the $36-40 billion range. The company's long-stated target of $40 billion in annual revenue for 2026 now appears operationally attainable, contingent on continued execution and sustained demand. SMCI's growth is anchored in NVIDIA's Blackwell GPU generation, liquid cooling technologies, and modular building block solutions architectures. Early 2026 order books for Blackwell-based systems stand near $13 billion, reflecting committed capex from hyperscalers. The Building Block Solutions platform enables SMCI to deploy Blackwell servers approximately 4 weeks faster than major competitors, providing a critical edge as hyperscalers accelerate capacity expansion. With chips exceeding 1,000 W per device, dense liquid-cooled rack deployments are required, and SMCI operates what is described as the world's largest production of liquid-cooled racks, with output near 5,000 racks per month. The global cooling systems market is projected to reach $21 billion in 2026 and expand toward $54 billion by 2034, with around 35% of total spending tied to AI infrastructure. SMCI's positioning intersects directly with both GPU server growth and this cooling spend, emphasizing its operational relevance in the AI ecosystem. More than 90% of quarterly revenue derives from AI GPU platforms, underscoring the company's focus on AI data center deployments rather than general enterprise refresh cycles. Approximately 84-86% of total revenue originates from the U.S., which simplifies logistics but heightens exposure to a concentrated set of North American hyperscalers and large AI buyers. The business is structured around 3 primary pillars: AI servers optimized with NVIDIA GPUs, liquid-cooled racks, and the Data Center Building Block Platform, dcbbs. In H1 FY26, dcbbs contributed roughly 4% of total profit, yet net margins exceeded 20%, compared with consolidated net margins near 3%. Management targets double-digit profit contribution from dcbbs by the end of 2026, positioning it as a key lever for structural margin improvement. Competition in AI servers and cooling is multifaceted. Dell Technologies leverages scale and supply chain efficiency to maintain gross margins above 20%, while Hewlett-Packard Enterprise combines high-performance compute with networking capabilities post-Juniper acquisition. Asian OEMs, including Lenovo, Inspur, Giga Computing, Asus, and Foxconn, often compete on cost, compressing margins. Additionally, hyperscalers such as Amazon, Google, and Microsoft are increasingly developing internal server architectures using proprietary silicon, including Trainium, Inferentia, TPU, and Maya, reducing dependency on external OEMs. SMCI's global server OEM market share has shifted from approximately 7.4% to around 4%, reflecting growth in AI alignment, but share erosion in broader server markets. The top 5 server vendors collectively saw a share decline from 33.3% to 22.6%, driven by local Asian players and hyperscaler in-house hardware. The principal risk for SMCI lies in margin quality rather than growth capacity. Gross margins have declined from 11.8% to the 6 to 8% range, with one quarter at 6.3%, and net margin has fallen from 6.9% to 3.16%. Operating cash flow in the last quarter was negative $23.9 million, and free cash flow was negative $244 million, despite net income of $456 million. Working capital changes are significant. Accounts receivable increased by over $8.4 billion quarter-on-quarter, inventory rose by $5 billion, and unearned revenue increased by several hundred million. These figures indicate SMCI is in a hyper-growth investment phase, pre-extending product and credit ahead of revenue realization. Management attributes margin pressure to discounting to secure large AI contracts, expedited logistics, component shortages, volatile input costs, and tariffs, particularly as new platforms scale. Sustained net margins near 3.1% leave the company sensitive to pricing, supply chain, and customer behavior shocks.